Joining us now, SoMA Equity Partners founder and CIO Gil Simon. Gil, thank you for being here. Your thesis, in contrast perhaps to some Fed officials, is that rates have peaked. What do you think that means for your investing thesis? And at what level do rates have to actually get to in order to really provide a significant tailwind for growth stocks? Because it's one thing for them to have peaked, but if they are higher for longer, I mean, is that enough really to, jumpstart some growth X the Magnificent Seven?
Yeah, I think, the most important thing to recognize is how heavily the rate change has weighed on growth stocks the last couple of years. So, it's been a really difficult market to own growth stocks now, and we're just looking forward to the rate of change kind of moderating. So we're not calling for a big decline in rates, but we're looking for an environment where hopefully the rate backdrop is stable and investors can focus on really durable growth stories, which obviously is what we're looking for.
Yeah, I've heard that from managers. It's not so much the absolute level, but the delta, and the uncertainty as far as the direction of rates. Do you think that that there is a recession as a prerequisite for rate cuts? And if so, what does that mean for technology investing right now? Because obviously rate cuts would make the cost of capital cheaper, but on the other hand, technology doesn't usually perform so well if there is a recession.
Yeah, like everything since the pandemic, I think it's complicated. There have been pockets of weakness already in enterprise spending now for going on 2 years. We've seen massive layoffs across certain subsectors and obviously belt tightening on spending. We think that there's probably going to be some consumer recession coming. When you think about big tickets items like autos, housing, of course. We even look at things like travel, which is very discretionary. Those are pockets that we're steering clear of. But outside of those areas, we've already seen pretty decent belt tightening, both in enterprise, and of course we like to own companies that have big recurring revenue streams. So we're looking for companies that can withstand even what we're kind of using as our base case as a shallow recession.
Yeah, that's been one theme coming out of the quarter, is that a lot of these companies had their earnings recession, made the necessary adjustments, and are now at least improving on margin. Just for example, is Roblox a good example of that?
We think it's a great example. Roblox is a stock that peaked at, I think, $140 a share a couple years ago, troughed around 20. I was on a couple months ago, talking to Leslie about it, and the call that we were making at the time was really, at the time we'd written a report and presented that margin leverage is coming to the metaverse. And we're really encouraged to see Roblox's earnings yesterday, which spoke to exactly that, which is, first of all, their EBITDA margins doubled from last quarter, Q2, 5% to 10% in Q3. But the company also put a line in the sand and said that this is really a new era for them going forward, where they're looking to really leverage the fixed costs of their business. They've been spending a lot post the pandemic because their platform has grown substantially. And so they're hosting an investor day next week, and we're looking forward to more information. But we're expecting the margins to eventually creep back into the 20s from 10% this past quarter.